Okay, I'll tell you what, we'll get started and we'll get some of the housekeeping out the way, and then we'll hand over to Paul to take us through the research. So good morning, good afternoon, good evening, everybody. If you don't know me, my name is Gary Forster. I'm the Chief Executive of Publish What You Fund and have been working on this DFI Transparency Initiative with my colleagues who are here today. We've got Paul James, who's our lead researcher, who's going to take us through the work. We've got Ryan Anderton, who's our research assistant. We've got Farzana Ahmed, who manages the project overall. And amongst the attendees, we've got our strategic advisor, Scott Dawson. We are recording this webinar today for those who couldn't make it, and we will post the resulting video on our website. Hopefully you've all received a copy of the report that accompanies this session. A final version of this will be posted on our project webpage later this week. If you do have any questions during the presentation, please feel free to put them in the chat and we'll try and pick them up at the end. If you'd like to speak, please say so in the chat and we'll try and give you a chance afterwards. We recognise that you may have other questions or thoughts that you might want to send us by email. So if we do run out of time, please don't hesitate to get in contact with us. So my colleague Paul will be speaking for around 20 minutes or so, and then we will move on to questions and answers. Paul, over to you.
Thanks a lot, Gary, and welcome to everyone who's attending. So this is our webinar which presents the findings from our 5th work stream of the DFI Transparency Initiative. Very briefly, what we're going to talk about today, we'll have a quick introduction to our project and our work, a brief methodology, and then we're going to highlight some of our main findings from the research and ask the question, what does the research tell us about the transparency of financial intermediary lending by DFIs? Finally, we will look at the next steps for the project, and then we will open the session for some questions and answers. And so just to introduce the DFI Transparency Initiative, it's a 2.5-year project. It looks at the use of public money by development finance institutions to meet global development goals. Our objective is to work collaboratively with DFIs and other stakeholders to increase the transparency of DFI activity. So throughout the project, we've worked with a group of multilateral and bilateral DFIs, and then we have used a evidence-based and multi-stakeholder process, which has been formed through a first phase of research and then also advocacy. And just a note that the report has anonymized results. This has been done on purpose, and it's intended to highlight the opportunity for sector reform rather than to focusing on the performance of individual DFIs. And just a brief overview of our work streams. Previously, we have looked at basic project information, which we classified as the first tier of information you can find about DFI's individual projects. Then we looked at impact management, objectives, theories of change, and impact. Then we looked at environmental, social, and governance transparency and the accountability to communities. So this included the way that DFIs communicate their environmental and social risks and the transparency of their independent accountability mechanisms. And our 4th workstream looked at the value of the investment. So it focused on mobilization, concessionality, and the structure of the deal. So the 5th workstream, which we talk about today, looks at financial intermediaries. Our workstream has been informed by an expert working group, and I won't go through the whole list here, but as you can see, we have a broad range of stakeholders, including think tanks, other CSOs, and a number of DFIs who participated in the research. So as I said, we are talking about financial intermediary transparency today. Financial intermediaries can be understood as the institutions in which DFIs invest that offer onward financial services. These include, but are not limited to, banks, private equity funds, insurance companies, and microfinance institutions. Lending to financial intermediaries has become an increasingly important aspect of DFI activity. Previous research by Oxfam indicates that FI activity represents over half of IFC and CDC's portfolio. And this research was conducted a number of years ago now, and evidence suggests that this proportion has only increased in recent years. And the reasons for DFI lending to financial intermediaries are many and complex, but probably central to this is the intention to improve the functioning of financial markets in developing economies. It offers the opportunity for DFIs to increase the breadth and depth of their lending, and it allows them to address finance gaps such as private equity gaps or housing finance gaps in developing countries. However, a lack of transparency means that it is unclear where a great deal of this development finance ends up. We are unable to ascertain the development impact that it has, and often the environmental and social risks that it holds for project-affected communities are not properly communicated. So a brief overview of the methodology that informs this research. We conducted a landscape analysis, and for this we focused on two types of financial intermediary. We focused on private equity funds and bank investments. We limited it to this type of institution as our kind of preliminary research and discussions with our expert working group indicated that this still represents the large majority of FI activity, and therefore would give us a good level of representativeness of the levels of transparency in the sector. We supplemented the landscape analysis with interviews with DFI employees, CSOs, private sector stakeholders, and other experts. And we held 2 meetings of the expert working group to discuss the landscape analysis and the draft paper. The institutions that we surveyed through our landscape analysis are listed in the table. So as you can see, we looked at bilateral DFIs, including CDC, DFC, Proparco, DBSA, and then also multilateral DFIs such as IFC, the Asian Development Bank, and the African Development Bank. So we're going to look at the findings from the research now. And just to note, we are limiting our discussion of the findings here to our findings regarding basic project information. So if you want to kind of dig into more detail about these findings, and particularly into the broader findings around, for example, impact management or financial structuring, these are all included in our working paper. So firstly, if we look at the levels of disclosure we found for bilateral institutions, you can see that we've split the analysis into 2 sections. The first of which is the FI level. So this is aggregate data about the financial intermediary itself. And the second is sub-investment level. So this is a question of can we tell where the money's gone, and if we can, what do we know about the sub-investments that have been made? So as you can see, there's a great difference between the levels of information, firstly, and significantly, although it was far from perfect, you could tell quite a lot of basic project information about the FIs at the level of the FI itself. So there was, in almost all cases, there were project narratives, there was project identification, as well as partner details and some level of information about ESG and progress of the projects. However, when we looked at the sub-investment level, we were only able to identify sub-investments for 2 DFIs, and in both cases, it was only for their private equity funds. For all other DFIs we surveyed, we could not identify any sub-investments, whether it was a private equity fund or a bank. So this really shows the kind of stark difference between the level of a financial intermediary on the one hand and the level of sub-investments on the other. We also have a couple of tables repeating this information for the multilaterals in our study. And again, you can see the difference is stark. And we actually found slightly more basic project information when it came to multilateral institutions. In particular, there was more project identification information, and there was better data surrounding the progress of projects. So rather than being limited to the year a project was started, there was more information on disclosure dates, for example, and approval dates of projects. However, again, we only found disclosure with two multilateral DFIs when it came to the sub-investment level. In both cases, again, this was for private equity funds, and only one of these DFIs was actually disclosing information for all of their private equity funds in a systematic manner. So we're now going to look at a couple of case studies of where we found disclosure. So in the first instance, we will look at two private equity funds. CDC are stood out as a DFI which do disclose their private equity fund sub-investments. They disclose the investment name, the country, region, sector, and start date. One particularly notable aspect of CDC's disclosure is that individual sub-investments, or as they term them, intermediated investments, can be searched for in their database. They can be downloaded separately. So it's a good example of how data can actually be linked up. So you can actually identify the intermediated investments individually. This is not the case for any of the other private equity fund sub-investment disclosure we found, where you actually had to access the page of the sub-investment, and then you just have listed, of the private equity fund, sorry, and then you just have listed sub-investments on that page. And then the second case we want to look at very briefly is a private equity fund called Creador 4, which the Asian Development Bank has invested in. This is significant because it actually marks an increase in the amount of information that a DFI is disclosing when it comes to sub-investments. As you can see, there are investment names and country of investment, as well as sector, which are data fields repeated across the four DFIs who currently disclose sub-investments. But there's also quite a detailed background narrative about each of the sub-investments, as well as environmental and social safeguard categories. So it gives you it certainly gives you an idea of the risk attached to each individual sub-investment. Currently, this is not the norm for Asian Development Bank's private equity funds, and communication with the DFI indicated that this is essentially a trial which they are looking to roll out to other private equity funds in the future. And as it stands at the moment, this essentially represents the benchmark for private equity fund disclosure. And hopefully this is something which, firstly, they will adopt more broadly, and then other DFIs can move towards. So if we move on to the question of banks, as we noted, we found we were unable to identify any sub-investments made by banks which DFIs were invested in. This is significant because numerous bank investments are valued in the tens of millions, and accountability organizations have highlighted significant E&S risks with certain bank investments in the past. So it's increasingly important that we're able to understand where the money from bank investments is going. Of particular interest to us is a commitment that IFC have made, which is to disclose qualifying sub-investments for their financial intermediary activity. Now, this is limited to a qualifying group of sub-investments. And briefly, the qualification for that as it stands is any sub-investment which is classed as category A, and then medium risk or category B sub-investments that are valued over $20 million and would be considered to be financing climate-related activities. And this is significant, and we'll return to this question in a moment, because essentially what IFC have done is set a threshold for the disclosure of their sub-investments. So it's a recognition essentially that they are unable or should not disclose every financial intermediary sub-investment that is made, but there's a certain threshold above which the risk associated with that type of investment is sufficient, that further information about it is needed, and it's important that other stakeholders can identify the involvement of IFC. Again, as with the private equity funds, this is a welcome development in the sector. It's currently a very new development, so although the reporting infrastructure has been built into two IFC investments, we currently do not have any disclosure against that infrastructure to date, although this will, we understand this will follow in the future. So then if we look beyond the level of the DFI and we look at financial intermediaries themselves, we identified numerous instances of where financial intermediaries disclose the type of information that we would expect DFIs to be able to disclose themselves. Via a deep dive that we performed into financial intermediary activity in Zambia, we identified a private equity fund called Silverlands One, which is managed by Silver Street Capital, and it primarily invests in agricultural and food industries in East and Southern Africa. Silverlands or Silverlands funds, they actually publish an impact and ESG report annually, and this report is disaggregated to the level of individual companies. So you can identify the company's actual ESG performance, as well as a series of impact indicators for the sub-investments from this fund. Another private equity fund we looked at was BaltCap, which is a fund invested in the Baltic countries of Europe and has investment from EBRD. And again, this private equity fund discloses an annual ESG report, which tracks their ESG performance across their companies, although it's reported in aggregate form. And this is important to note because firstly, it shows that a lot of this information is actually already in the public sphere. So the barriers to disclosing it are arguably limited. But it also shows a change in the industry at large, where the ability to communicate how an institution manages its ESG risk and how it has an impact in terms of development have become important kind of aspects of the marketing and the market creation that these types of institutions perform. So we're already seeing incentives essentially for this type of disclosure. We're seeing examples of it taking place. And therefore it really indicates that DFIs, who are essentially the original impact investor, should and could be encouraging this type of disclosure and then partaking in it themselves. Finally, we looked at a series of African commercial banks. And so we have the example here from Equity Bank Kenya. And what we found was in almost all cases, firstly, DFIs were the predominant lender to these banks. In many cases, it was over 90% of the finance these banks received came from a community of DFIs. And secondly, in their own annual integrated reporting, the banks would often disclose far more financial information about the loans and other investments they had received from DFIs than the DFIs disclose themselves. For example, Equity Bank in Kenya disclosed the outstanding balance of its loans, the nature of the loan it had received, security involved, the currency of the loan, and the interest rates. In addition to this, there were often what were called financial covenants disclosed, which are essentially rules attached to loans, which may include information such as the number of non-performing loans that a particular institution is allowed to be carrying on its books. So again, this information has been made publicly available. It's in the public sphere, which suggests that there is an avenue for DFIs to actually publish this information as well. So then if we briefly look at kind of what this research tells us. Firstly, the overall level of DFI FI transparency is low, and it's particularly low at the level of the sub-investment. This makes it near impossible to track the flow of development finance. As noted before, there are a number of reasons this is important. It's important to understand the impact that this type of finance is having, particularly as it makes up such a large proportion of DFI activity. And it's also important for project-affected communities to understand where DFIs are involved, or if DFIs are involved. This is important because, as we know, almost all investment or development activities carry some form of environmental and social risk. And where that risk becomes a reality, it's important that project-affected communities are able to seek redress, and to do so, they need to be aware of the involvement of the DFI. As noted and exampled above, we identified numerous examples of disclosure via sources other than the DFI. This highlights the ability to disclose much of this information, and in many cases the market case for doing so as well. The fact institutions are doing so on their own volition indicates the worth of this type of information, not only to other stakeholders, but to the actual financial institutions themselves. One example of practice outside the DFI sector that we identified was that of the Equator Principles. And the Equator Principles are a series of principles which essentially govern the way that financial institutions disclose high-risk projects which have an environmental and social risk attached to them. This is significant because it's an initiative which is included in private sector banks and actually shows a higher level of transparency than that we are currently seeing from DFIs, which really indicates there is room here for DFIs using public money to move towards the best practice of the private sector currently. And it also offers some useful questions around the threshold of disclosure, which we will discuss in a moment. And finally, for this section, we should note that the disclosure of information about a sub-investment, so the client of a financial intermediary, is often governed by national banking regulations. This was repeatedly cited as a reason why DFIs struggle to disclose information about their financial intermediary activity. However, previous research and our own discussions with numerous experts in this field have asserted that this concern can partly be addressed by the financial intermediaries seeking consent to disclose from their clients. So while privacy laws might prevent the automatic disclosure, DFIs could certainly make it a requirement of their financial intermediary clients that they in turn actively seek consent for disclosure for their on-lending. So now we're going to discuss the opportunities for increased transparency. And again, we want to return to this idea that we are thinking of financial intermediary lending at two levels. First of all, at the level of the financial intermediary itself, and then at the level of the sub-investment. At the level of the financial intermediary itself, we are proposing that the level of transparency can broadly be treated in the same manner as direct lending performed by DFIs. We know that DFIs are tracking the performance of their financial intermediaries. Our research found numerous examples of DFIs disclosing indicators for their financial intermediary lending, even though results were rarely published. And we're also aware that IFC are intending to disclose summaries of their client FIs, environmental and social management systems, or ESMSs. So while the documentation may differ for a financial intermediary as opposed to a direct investment, it certainly suggests that it's possible for this type of information to be disclosed as appropriate. And that brings us to the question of what could and should be disclosed about financial intermediary sub-investments. I think the first thing to note here is that a large proportion of financial intermediary activity takes place in the micro and small and medium enterprise sectors, the MSME sector. Reporting from IFC indicates that their FI clients make in the tens of millions of loans as sub-investments to the MSME sector. this really kind of then raises a question about, first of all, is this feasible? Do we really need to see MSME loans? And our conclusion to this was that essentially MSME loans carry a lower, although not non-existent, environmental and social risk. And typically those types of, that type of FI activity is intended to have a development impact at the level of the financial intermediary. So this could be to correct distortions in the housing market, for example, or to plug gaps for SME financing. But at the same time, we are aware that there's a certain amount of financial intermediary activity which is going to larger and higher risk projects. And this is the type of information, these are the types of projects which we want to see information for. So we've proposed a form of filter, which is essentially asking a series of questions. The first of which is whether or not a DFI is materially exposed to the sub-investments. So this recognises that different types of investments in DFIs have essentially inferred different levels of exposure. So if a DFI is to make an equity investment, for example, in a bank, then we can reasonably argue that they're exposed to the totality of the activity of that bank, whereas a ring-fenced loan, you couldn't make the same argument. So our argument is, if a DFI is materially exposed to a sub-investment and it is a category A sub-investment, then this should be disclosed. And if not, then a threshold similar to that suggested by IFC should be applied to determine disclosure. Now, as noted above, the Equator principles actually have their own series of thresholds, and these thresholds are more stringent than the ones currently proposed by IFC. So while IFC's thresholds are to be, or commitments are to be welcomed, it is our position that given the fact that there's a private sector benchmark, which is even more stringent, this is an appropriate level for sub-investment disclosure. So this would mean that if a project was either category A or was below category A and larger than $10 million in terms of project loan, then we would expect to see a limited series of data fields which allow us to identify what that sub-investment is. Okay, and if we move on to the next steps for the initiative now. And we are in the process of concluding this work stream and the research. And as Gary noted at the start, we are open to feedback and would welcome any questions after this presentation. And then the next step for the project as a whole is the launching of what we are calling the DFI Transparency tool. This tool is informed by our research across the 5 work streams to date, and has been developed to date from that research and in collaboration with the stakeholders that we have already discussed. The intention of the tool is essentially twofold. Firstly, we are trying to offer a product which creates a roadmap for DFIs to improve their transparency. It details at a granular level the types of information that are required according to a series of themes, and by a range of stakeholders. We are undertaking consultations on the development of the tool during August and September, prior to the launch of the tool, alongside a report supporting it in early November. Following the launch of the tool, we will continue our advocacy and collaboration with DFIs, and then we will conduct a pilot phase assessment of DFI transparency according to the tool in 2022. Okay, so that wraps up the presentation phase for this. I think I'm going to hand over to Gary to look for any questions or open the discussion to the participants.
Thanks very much, Paul. So there's a lot of information there in the report. Paul's just given us a good overview. Please feel free to put some questions or comments in the chat, or put your name in and we'll call on you if you want to make your comment verbally. The one thing I will add is, with this work stream, more than arguably more than any of the previous four, we've been cognizant that we've been very much standing on the shoulders of many advocates and researchers who have been working on financial intermediaries for many, many, many years. So just wanted to extend a thank you to those individuals within the CSO community, but also some in DFIs and think tanks who have been wrestling with this stuff and trying to move the needle on this for some time. Their support was extremely useful. So there's one comment at the moment. One improvement would be searchable directories of investments by investee, region, type of investment, instrument, and so forth. Paul, do you want to kind of at a macro level give an explanation of what you found in terms of such directories? Because obviously you looked across so many multilateral and bilateral DFIs.
Yeah, so I think there's almost kind of two questions there. There's the question of the investment into the financial intermediary, and then the investment into the clients of financial intermediaries. Speaking to the first level, I would say that increasingly DFIs have fairly sophisticated databases where you can search for the investments into the financial intermediary itself. The quality is variable, but there has certainly been movement in the right direction there. Certainly when you get to the level of the sub-investment, that is not typically available. The best example of availability for that, I would say at the moment, or practice, comes from CDC, where you can filter via intermediated investments, which is their term for sub-investments from private equity funds. And you can identify them as a standalone investment within CDC's portfolio.
Thanks, Paul. And then there's another comment, somebody saying that when they worked in a private equity firm, they'd be periodically asked by host country government entities to disclose their LPs, and some development banks would refuse to release us from non-disclosure agreements. I'd like to know why there are even non-disclosure agreements about where development banks have invested in funds. Yeah, I mean, this is a question that we've asked ourselves from the outset of this project, and we've done a fair amount of work speaking with the legal counsels at various DFIs to understand the extent to which non-disclosure agreements are used and why and where. We've specifically, we found in the impact work stream that it was a lack of exemptions in the non-disclosure agreements to include disclosure of granular impact data that prevented DFIs from then sharing performance information about their investments. And we found examples of individual investment organizations that had actually found ways around that and had included such exemptions in their non-disclosure agreements. I can't answer your question of why there are even NDAs about where development banks have invested in funds. We know that in other areas, for example, we know that in the UK, government funds, especially where there are subsidies, are tendered often much more transparently, and non-disclosure agreements are not assigned to subsidy contracts for things like green energy. However, this might be part of just the historical inertia of these large institutions trying to minimize their risk when it comes to these things. What we do know is that these things can change, and that if the incentives are right, contracting processes can be re-engineered to enable transparency, unless there are, as Paul mentioned, sort of prohibitive national regulations. You know, and this is a core finding of our work, is that to some extent where there is a will, there is a way, and processes can be amended to enable disclosure of certain information. Now, the implications of that for this project are, one, we need to make sure all of the legal advisors are on board with what we're doing, and two, we probably can't expect retrospective transparency on a lot of the investments that have already been made because of the financial and administrative cost of going back and renegotiating all of those contracts, assuming the investee wants to. So it is something we've looked into. I don't think we have all the answers, but what we have done is the fields that we are proposing in the transparency tool that, as we said, we're consulting on at the moment, we do know that for each of those fields, there is an example of a DFI providing that information at the moment. So we know that somebody somewhere has found a way to get around these transparency hurdles. looking at the questions. A question I have is on separation of disclosure for SME financing through DFIs and that for large projects. I appreciate the limitation of researching on funds to SMEs, but given the rise in SME financing, is there scope for further investigation? So I think this speaks to some of the threshold discussion that we've had. Paul, do you want to pick that up?
Look, and first I'd say, look, this is a kind of ongoing discussion that we have had as a team, and it's not something which is clear cut. And while lending to SMEs on a kind of loan by loan basis or investment by investment basis might have smaller E&S risks, for example, when you aggregate them, you can end up with very significant risks. So this could be kind of individual cases of labour law risks, which when aggregated across many E&S investments kind of become significant. However, I think one thing we just did have to lean into is there's a kind of feasibility requirement here. And one of the functions of SME lending is to reach the types of clients which DFIs otherwise can't reach, and to increase the depth of SME lending in economies which have kind of documented shortages of this type of finance. So while we kind of recognise it's not a kind of risk-free environment, I guess it's a recognition that the risks are generally lower, and therefore reporting at least at an aggregate level. So asking, for example, that a financial intermediary has a ESMS, or an environmental and social management system, in place, and that this is disclosed by the DFI, represents a kind of step in the right direction to understanding that how DFIs are managing their risk in this type of lending.
Thanks, Paul. There's a couple of comments here that might have just come to the panelists. So the first is, how will the DFI tool be similar to or different from the IATI structure and requirements? Why not use IATI for DFI transparency? So if you're not familiar, IATI is the International Aid Transparency Initiative, and they have a reporting standard, which is an agreed way amongst development stakeholders to disclose information on development projects. We started with a blank piece of paper for this project, although IATI representatives have been involved from the start, and we're on some of our expert working groups. We have ended up with a tool that aligns quite closely to many of IATI's requirements, but there are some nuances in how DFIs do what they do that IATI cannot currently accommodate. So when we, during the consultations, when we publish the final version of the tool after the consultations, we'll be including a note to show which fields align with IATI. So we won't be expecting significantly greater disclosure from the DFIs. And we then need to work with IATI in the coming years to make sure that the standard can accommodate some of the things that we've been asked, that we'll be asking DFIs to disclose. So we're still working some of that out, but we have tried where possible to make sure it's aligned and it doesn't duplicate or contradict too much. There's a question here: how feasible do you think for DFIs to be obliged to disclose sub-investments during project approval? How can we make DFIs embed this disclosure requirement into their respective policies? Paul, did you have a view on that?
So again, I think this is almost kind of two parts. There's the obligation of a DFI to disclose it, but there is, unfortunately, as well, the ability of a DFI to disclose this information. And so, as we noted, there are often privacy laws, which mean the DFI would be reliant, and also the financial intermediary itself would be reliant on consent from the client to disclose this type of information. So the feasibility, or rather the obligation for a DFI to disclose it, is perhaps only kind of part of the puzzle. Even if a DFI was obligated to do so, there isn't a guarantee that on a kind of case-by-case basis this disclosure would take place. However, what certainly could be achieved is an obligation that the DFIs, sorry to use obligation twice, but the DFIs have an obligation of their financial intermediary clients to seek this disclosure. And something we have proposed is that if this disclosure is sought and the consent is not given, then we would ask that a DFI is specific about the reasons why disclosure can't take place. So rather than a kind of generic claim to commercial confidentiality, it would be necessary to cite the relevant banking privacy laws which have prevented the DFI from disclosing the information.
Thanks, Paul. So there's a question here. It's clear that there is a parlous lack of transparency about where a significant proportion of development finance ends up after it's channeled through financial intermediaries, especially banks. Is there an acknowledgement from DFIs that this cannot continue and a real willingness to change? Recourse and others have catalogued FI sub-projects which have led to severe human rights and environmental harms, and without transparency, it's impossible for communities to access remedy from the DFIs. So to answer the question, is there an acknowledgement from DFIs that this cannot continue and a real willingness to change? It's a mixed bag, is the truth. I mean, we've looked at a large number of multilateral and bilateral DFIs as part of this. There are definitely those organizations that want to be more transparent around their FI investment for a variety of reasons, and partly because they feel like their way they manage their FI investments is responsible and comprehensive, and they do the risk assessments and collect the various information that they need to collect to be a legitimate and a responsible investor, and they want to demonstrate that. So and throughout this project, we've seen that split in the DFIs. Those organizations that see this as purely a transparency and disclosure initiative, and those that see this as an opportunity to really showcase the way that they invest responsibly, the information they collect, the strength of their relationships with their investees, and so on. So there are definitely some. To be completely honest, there are a couple that are very nervous of FI disclosure because it does open up portfolios that maybe were agreed historically and maybe include investments that aren't so palatable today. But I think with the transparency tool, we're already sort of building a bit of support for that, and the fields contained within it. So I'd like to think that if we can get a critical mass of institutions on board, that hopefully that will encourage others to join as well, or at least will showcase where the laggards are. There's a question that's come in here. Thanks for the presentation. Quite telling, the red colour showing the lack of transparency in the majority of DFIs. How DFIs reconcile the difference in transparency between their direct investments to private companies in the same countries with some challenging legislation, but still they are able to disclose information, IFC for instance, and why they cannot require their clients to do the same with their FI sub-clients. There's some devil in the detail there in responding to that. Paul, do you feel like you want to take that one on?
Sorry, I'm still reading the question. Bear with me. So I think it makes a valuable point, which as you know, as we have mentioned, there are limitations to what a DFI can kind of force to be disclosed when there's regulations around reporting. If you take a lens which goes beyond purely transparency, I suppose the argument could be made that DFIs simply shouldn't invest in financial intermediaries who are unable to obtain consent from their clients, or there should be a condition that clients shouldn't make sub-investments which are not able to be disclosed. So if a sub-investment couldn't be disclosed, then it shouldn't be made. I think we have to recognise there are risks to that. If DFIs are making equity investments and are exposed to a entirety of a bank's portfolio, and as we have seen, kind of banks in East Africa, for example, are almost wholly reliant on DFI finance, it could exclude a significant portion of SMEs or enterprises in a given country from receiving finance unless they agree to disclosure. Now, from the perspective of knowing where money is going, that is perhaps a positive step, but also there's at some level a kind of requirement to respect national law and national requirements as well. So I think that there are some risks associated with the kind of forcing of disclosure at the client level.
Thanks, Paul. Sorry, just seen that somebody's got their hand up, which I had missed. Aubrey, please take a comment.
Yeah, thank you, Gary. I was just going to comment on what Paul said on that last question. I think the issue is not countrywide regulation on why you can report direct and versus the financial intermediaries. In the most case, banking regulation is very different than countrywide regulation. So banks face all kinds of different regulation and therefore have different there are different regulations you'd have to comply with. So it's not like a natural, like just because you disclose a direct investment in the country, that there isn't other rules that apply when you're dealing with local banks. That's all.
Thanks.
Thanks, Aubrey. And there's a comment here, will the 2022 pilot assessment be done without naming names? So it's our intention to name names in the 2022 pilot assessment. We'll be doing that because we've got the opportunity over the next year, firstly, to engage meaningfully with the indicators that we'll be using during this consultation that we're doing at the moment, but then also as we develop a methodology for measuring performance against those indicators. And we're also looking forward to engaging with DFIs throughout next year to actually say, look, we've looked at your data through this research. We know where there might be opportunities to help you improve and so on, very much as we do with the Age Transparency Index. So we think that as a result of spending all of that time and energy collaborating with DFIs and being super clear on what the metrics are and how we've scored them, we feel it's only right to name names, partly to reward those organizations that have already suggested to us that they're looking to change their processes, and actually some of them currently are changing their processes as we speak to disclose more of this information, and we want to make sure that that's rewarded, but at the same time to highlight those institutions and hopefully apply pressure from the executive upwards to where there are laggards, where there are organizations that aren't as transparent. Hopefully that answers the question there. Okay, I don't see any more questions. I'll ask one of my colleagues to put an email address in the in the chat, which you can send us an email if A, you have any further questions or comments, but B, also if you wanted to be able to if you wanted to get involved with the consultations that we're doing around the transparency tool and you haven't yet received an email on that, you just feel free, drop us a note and we'll make sure you're included. One final comment here, somebody saying, thanks Aubrey for the clarification, but what about private equity funds then? DFIs should be able to require that disclosure to their PEF, right, to their private equity fund. Right, Aubrey, I don't know if you want to respond to that.
Sure. I mean, again, in most cases, a lot of private equity funds already disclose their sub companies. If you look at their websites, et cetera. So I think aligning on the private equity side is easier than the bank loan portfolio side, because an average private equity fund, even their first fund, may have like 10 portfolio companies. That's a way easier context than all the loans that's done in on lending. So honestly, I think we'll make a lot more progress on private equity disclosure of portfolio companies than we will on the bank loan portfolios.
Thank you. So then in that case, it just leaves me to say we will be launching the transparency tool at the end of October, early November, and we look forward to having everybody there. We've got your contact details, so we'll let you know when that's happening and how you can register. Between now and then, if you've got any questions or advice, please get in contact with us. My colleague Fazana has put her contact details in the chat. So just a huge thank you for attending today. Thank you to everyone who's here today that's also contributed throughout the project as well. We appreciate it. Thank you very much, everybody. Let's call it to a close.